Now, there are many types of business entity forms. We cover the three major forms. The first business entity form is a sole proprietorship. Sole proprietorships are typically owned by one individual, and this individual has unlimited liability. What does unlimited liability mean? It means that if the business was sued, the individual is personally liable for all actions. And if something happens, the person being sued can actually have their home taken away. Any personal assets that are outside of the business can be lost. Also, in addition to having unlimited liability, the sole proprietorship is not subject to income tax. So the business doesn't pay income tax. Rather, it is what we refer to as a flow-through entity. All the money that is made by the business flows through to the individual on their personal income tax return, meaning the 1040 Schedule C. Second business entity form is a partnership. Partnerships are owned by two or more people. In a general partnership, the partners have both unlimited liability, meaning they are both personally responsible. The partnership is also not subject to income tax. It doesn't pay its own income tax. Rather, it is another flow-through entity. So each partner would take their share of income earned or a loss, whatever the case may be, and it would be reported on their personal income tax returns. The final business entity form is a corporation. A corporation is a separate legal entity, meaning it pays its own taxes. The owners of a corporation have limited liability, meaning they are only liable up to the amount they have invested in the business. What are the owners referred to as? They are shareholders, stakeholders. There's lots of terms that refer to the owners of a corporation, but your book mainly refers to them as shareholders. Now, because the corporation is a separate legal entity, the corporation is responsible for filing its business income tax returns. Now, finally, with regards to a corporation, corporations are subject to double taxation. And this means that if the business earns income, they file their tax return and pay taxes on their final income. Now, at any point in the future, if the business decides to give dividends to its shareholders, when the shareholders receive those dividends, the shareholders must report that as income earned, thereby making it taxed. So, the money from a corporation is taxed at the corporate level, and if they give out dividends, then it is taxed at an individual level. That's the double taxation.